Hello, people. I'm Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month at noon Pacific time. Thank you for Cal CPA for sponsoring this and helping make it happen. Really appreciate the tech support and the platform and all of that, and frankly, this is kind of fun for me to do. I like it. You can listen to these online. You're doing that right now over the phone, or we post them up later on YouTube so you can grab it there at your leisure. This month's topic is going to be Introduction to Form 5472. Are you required to file it? So this is a painful little form that if you mess up, there's a nice $25,000 penalty waiting for you. And true confessions, we've had to throw ourselves under the bus because we've screwed up this are you required to file yes or no problem. Thankfully, we've gotten relief from the penalties. Anecdotally, I've got to tell you that the IRS seems more and more grim on giving you reasonable cause relief, so don't F it up, right? Anyway, so the important thing for this topic today, I'm going to go over the whole form, but we're going to focus on the question of, do you have to file it or not? And once you've decided you have to file, then you file it correctly, of course. So let's get started. This is the topic. As you can see in the table of contents, 2, 3, and 4, 3 different definitions. And this is the holy trinity of you have to kind of figure out ahead of time. You have to do a lot of prep work for this form just to decide whether you even have to file the form or not. But these are the 3 things that you're going to have to figure out. Do you have them, yes or no? So, diving in. The objective here, I just want to reemphasize, I'm just talking about the filing trigger for Form 5472, not what goes on any particular line or what does the IRS mean in the instructions and stuff like that for some esoteric question in the back of the bus of the form. We're just talking about, yeah, I know I've got a project on my plate and I've got to file this form. Here is the holy trinity of when you have to file the form. Think of it as this Venn diagram, and where all 3 of these circles overlap, there lives Form 5472. Do you have a reporting corporation? That's a defined term, and we'll figure out what it means because it doesn't mean just corporation. Do you have a related party? And as you might guess, anytime you hear related party in the context of tax law, you've got a bunch of attribution rules and other wonderful stuff like that. And finally, you have reportable transactions between the reporting corporation and the related party. So think of this as, I know I've got trouble when I have a reportable transaction that I've identified between a reporting corporation and a related party. So it's a transaction-driven form. And therefore, I'm going to tell you at the end as I wrap it up, but the way to look at this is first go through the general ledger of the reporting corporation and look at the transactions, money in, money out. And when you look at the counterparty of those transactions, try to figure out in your head, is this a likely suspect for being a related party? And that's the way that I've found is most efficient in trying to figure out whether there's a Form 5472 filing requirement or not. Start with the general ledger, boil that down from all the transactions, just a few, look at the counterparties, and then figure out what's going on. Now, let's start with the first of these topics, the reporting corporation. And I'm going to run this presentation in the sequence of the form itself. So remember, I said a Form 5472 filing requirement occurs when you can identify the intersection of those 3 circles, the reporting corporation, related party, and the transaction. And I've also told you as a practical matter, start with the reportable transactions. But I'm going to just follow the form here because that's what we do. We follow instructions. We're tax lawyers. So, what's a reporting corporation? Here's the definition in the code. It's a domestic corporation, and it is 25% foreign owned. So the original plan of this thing is to fight earning stripping, or at least to make it visible to the IRS so they can challenge an audit. So if you have a domestic corporation and a foreign parent, and the domestic corporation is larded up with all sorts of expenses payable to the foreign corporation, services, interest, whatever, then what's happening is taxable profits are being stripped out of the United States and paid upstream to the foreign corporation, which is outside the U.S. tax system, and therefore Uncle Sam loses out on tax money. So this is the idea that originally planned. And as you can see, when we go further on in the definition of a reporting corporation, it kind of metastasized from there as Congress said, oh, well, actually, let's do this. But this is the beginning. Your domestic corporation, 25% foreign owned. And there are it's always a double-barreled shotgun in defining what is a reporting corporation. And this slide gives you the first hint that there are three types of entities that can be reporting corporations: domestic corporations and disregarded LLCs. And the double-barreled shotgun is the right kind of domestic entity, namely corporation or LLC, and at least one 25% or more foreign owner. The double-barreled shotgun for a foreign corporation is the right kind of foreign entity, namely a foreign corporation, and it is engaged in business. And note here, please, that the 25% ownership threshold is irrelevant, and indeed foreign ownership is irrelevant for triggering the Form 54 filing requirement. So you can see how this is an example of how things metastasized because you went away from this ownership concept to engaged in business, and you went away from domestic corporation to other types of entities as well. Still, the idea for a foreign corporation being a reporting requirement is the same, because if you have engaged in trade or business in the United States and they're filing a Form 1120-F and basically calculating their taxable profit in the United States the same way that a domestic corporation would, there's the opportunity for stripping income out of the United States and sending it overseas and outside the U.S. tax system, and that's what's trying to be captured here. For the domestic entity that's a disregarded LLC, that's purely the government trying to bring to the surface the ultimate beneficial owner of disregarded entities so people can't use the United States as a tax haven. So it's unrelated to the earning stripping concept. So here you have remember I said it's a double-barreled shotgun. So part one is the first barrel, what kind of entity you have. And so you can see, it says date of incorporation, this, that, and the other. So you're identifying the type of entity that you have in part one, and there's a bunch of other stuff, what's your name, where do you live, blah, blah, blah. And then part two, the other barrel of the double-barreled shotgun, is the foreign ownership. And note here that they want to see the direct shareholder, namely whose name is on the share certificate of this reporting corporation, and they want to see the ultimate indirect shareholder. When you go all the way up the wedding cake of structure, whatever it is, where do you stop and who is that person? So they want complete transparency into the reporting corporation's life and ownership. So this is where we're living right now. So starting with part one, what kind of entities qualify? We already sort of gave you the clue in the previous slide, which is you're going to have domestic corporations, which is how this whole Form 5472 thing started. And then we have domestic LLCs with one foreign owner, so they're disregarded entities. And that was in response to other countries in the world saying, hey, the United States is a tax haven and people are hiding money there, which is absolutely true. And so this is the long, slow march to complete and utter transparency, and beneficial ownership is disclosed everywhere all the time. And the third one is foreign corporations that are engaged in business. So Those are the three types. If you have any kind of entity that's not one of these, you don't have a 5472 requirement. You might have some other problems, but not that. So, here's the first one, domestic corporation. Yeah, we know what domestic means. Entities organized under federal law, like a bank that has NA behind it, and God help you if you're preparing a bank tax return, or one of the 50 states or the District of Columbia. That's a state. Corporation, we know what a corporation is, and if you don't know whether you have an entity that's a corporation or not, you're going to ask for the organizing documents, the articles, and if you have something that says LLC on it, you're going to ask, hey, did you make a check-the-box election for this thing, yes or no? And that's the way you're going to find a corporation exists. A domestic disregarded entity is also a corporation. So here's the site to the check-the-box rules underneath Section 7701 of the Code. And so this sort of brings to mind the old joke that Abraham Lincoln is reportedly said, how many legs does a dog have if you call a tail a dog? Well, the answer is 4. It still has only 4 legs. Just calling it a tail doesn't make it a dog. Calling a tail a leg doesn't make it a leg. Same thing here. We have an LLC that's still a disregarded entity, but just for this special purposes, the fiction is that we're going to call it a corporation. So they do what they're going to do. But that's the clue. And the third one is the foreign corporation. And note here that the definition, you go straight to reporting corporation status if you're engaged in business, and you don't even have to think about ownership. So you could have a foreign corporation that is 99% domestically owned, 1% foreign owned, or indeed 100% domestically owned, and you can still have a reporting corporation in existence. So watch out for that. Let me go back to the foreign corporation. Foreign corporations, you're going to have to look in the check-the-box rules to see what kind of entity you have. And in the check-the-box regulations under Section 7701, you can go look at Form 8832 instructions, and you can get most of it there. You have any kind of foreign entity, business entity, and you can't trust whether it says Inc. or Limited or LLC after it in order to figure out what it is, whether it's a corporation for U.S. tax purposes or not. What you're going to have to do is figure out what it is under the check-the-box rules. And there's a whole list of what are called per se corporations. They're corporations no matter what. And then everything else is an eligible entity, and it's going to be default a corporation if all of the owners have limited liability. And then so that's the basic way you're going to go. I would say in your head, just assume pessimism and assume it's a foreign corporation, even if it's a foreign entity that says LLC on the end, until proven otherwise. So let's move on to the second barrel, the 25% owned. So again, we go to the core definition of what's a reporting corporation here in the code, and it says 25% owned. What does that mean? Well, what it means is you have at least one 25% or more foreign shareholder at any moment in the tax year. So even a day, right? Even a minute. So, and what's a foreign shareholder? Well, it means direct foreign shareholder. Your name is on the share certificate. Or it means indirect, which has a double-barreled definition. Quotes, owns indirectly, which incidentally is not defined anywhere in the Form 5472 laws, or the attribution rules under Section 318 make you an indirect 25% foreign shareholder. So this is your quest to find who are the direct and who are the 25% indirect foreign shareholders. Fortunately, for our compliance purposes here on Form 5472, this RevProc here, 91-55, says, don't worry about the 318 rules. Just apply the indirect ownership rules out of the CFC code sections, specifically section 958A1, which is direct ownership, and 958A2, which is indirect ownership. And these are pretty simple to apply because you just draw an org chart of your structure with the reporting company at the bottom. So here I've got an example. And then you just do your pro rata allocation of ownership all the way down the org chart until you figure out what your entity or human at the top actually owns. So here's a really simple example where we have a foreign parent corporation, and then we have a foreign subsidiary, and then we have a domestic subsidiary underneath. So what do we put in part 2? And more specifically, have you defined to your satisfaction that you have a reporting corporation? The direct 25% foreign shareholder is the non-U.S. corporation, subsidiary 1. Now, indirect is weird because we have a couple of indirect. We've got the parent foreign corporation in the middle, which is an indirect foreign shareholder according to the rules. And then we have the human at the top, who is the ultimate indirect 25% shareholder. So for purposes of Form 5472, all they want in part 2 is the ultimate person, who's the one at the top, and who's the direct shareholder at the bottom, and you don't have to report the intermediate ones in the middle. So this is the way that you figure it out. Draw the org chart, figure out what it is under the principles of Section 958A2 for indirect ownership, and then off you go and you decide whether you've got something where you have to fill in this information on Form 5472 or not. So some quick examples. Everybody is unrelated, 20%, right? Nobody hits the 25% shareholder limit, therefore this is not a reporting corporation. That's on the left for 5 owners at 20% each. On the right, something 80-20, so a U.S. person owns 80% and a foreign person owns 20%. Not foreign owned. It's got a 20% shareholder that's foreign, doesn't hit the threshold. Domestic corporations are where I see some problems and some failures, and so this is where I want to spend a minute and give you this slide. All that's required here is you've got a foreign person, and it's a disregarded entity, so you only have one owner, so there's the 100%. And these are going to be reporting corporations. And then the only question is whether there's a transaction, and I'm going to show you why. In every case, there will always be a transaction. But these are going to be reporting corporations, so put your spidey sense on. For whatever reason, anytime you have an LLC and you have a foreign sole member. And this middle one, where you have a foreign person owning a domestic LLC, and they got a bunch of foreign activity going on. This is the kind of tax shelter game that people were playing. You set up a Delaware LLC, nobody really knows who owns it, and you do all your business offshore, and then offshore, and you're a non-resident person. People think they're doing business with a U.S. entity and everything is cool, but in fact it's not. It's running straight through to you as a non-resident individual of the United States. So always, 100% of the time, domestic LLCs are going to be reporting corporations. 100% of the time, they're going to have a Form 5472 filing requirement at the end. The other place I see problems is foreign corporations owning U.S. real estate. And this can get a bit tricky because remember how a foreign corporation comes to be a reporting corporation, in quotes, if it's, quotes, in doing business in the United States, close quotes. So if you have to look at what's happening with the real estate underneath and decide whether that rises to the level of, quotes, doing business, close quotes. So on the far left, rental real estate. Rental activities are doing business, so this is a reporting requirement. Form 5472 goes along with the Form 1120F. Next thing, which is people do this all the time, set up a foreign corporation. The foreign corporation buys a house or a condo in Vail or whatever, and it's just for purely personal use. Well, this foreign corporation is not, quotes, engaged in business, close quotes, at least until the IRS or Congress changes the rules and makes some sort of attributed, quotes, doing business, close quotes, if somebody uses property for free. So you are not in a Form 5472 filing requirement in this situation. Foreign corporation that owns a house or the condo in Vail that's only used for personal use in the year of sale. Now you have a Form 5472 filing requirement because our friend Mr. FERPTA, Section 897, says the gain from sale of U.S. real property is treated as if it's connected with engaged in trade or business activities. And therefore, because you've got that kind of activity that's defined as connected to U.S. trade or business, you got a Form 5472 filing requirement in the year of disposition. And then the final one on the far right is a foreign entity that's an eligible entity to be disregarded, and indeed the corporation makes a check-the-box election to be disregarded for U.S. tax purposes, not a reporting corporation, because only domestic disregarded entities can be reporting corporations, not foreign disregarded entities. Tricky, huh? Reporting corporation summary. Watch for these three types of entities first. If you see one of these three entities, spidey senses go up, dig deeper. Next, remember we've got the holy trinity of reporting corporation, related parties, and reportable transactions. We're moving on to related parties here. And this is part 3. All the fun and games here for you, and this is where you're doing a lot of prep work just to decide whether you're going to file Form 5472 or not, is on that line 8E, relationship. And you'll see there are 3 checkboxes. We're going to walk through what they mean and how you kind of figure out whether you have a related party, and if so, related in which way and related to whom or what. So here's the definition out of the regs. So you see there are 3 types of related parties, and quite coincidentally, on line 8E of part 3, it says there are 3 checkboxes. So we're going to fit ourselves into one of these 3 checkboxes. So first checkbox, 25% foreign shareholders are related parties. So here we are, the far right checkbox, 25% foreign corporation. Foreign shareholder, pardon me. So you're going to look at part 2 of your Form 5472, where you did all that work identifying the 25% foreign shareholders. And anybody who is on that list, including those intermediate people that you don't have to report in part 2, but in fact they are 25% indirect foreign shareholders, those are going to be related parties. So when you go to the general ledger and you're hunting for transactions that might be suspect, and the counterparty might be a related party, this is going to be your list of related parties that you're going to compare the general ledger transactions to figure out whether the filing requirement exists. So, quick summary. The foreign shareholders, the 25%, indirect, direct, we've talked about what that is. And remember, for a disregarded entity, there's going to be 100% member, so that's going to be your only foreign shareholder. So again, just to illustrate where on part 2, remember this middle tier, the parent foreign corporation, didn't have to be reported in part 2, even though it's an indirect shareholder, but you don't report it. In part 3, it's a related party, and you may have a Form 5472 filing requirement for transactions between the reporting corporation and that related party. Next, we're going to dig into the weeds and the painful part, which is related party rules. So now we're not just looking at foreign shareholders that are easy to identify. We're looking at people who are related to 25% foreign shareholders, direct or indirect. And this is where, things start to get painful and baby Jesus weeps. You're going to have to dig into the attribution rules, constructive ownership rules, and the regs are going to tell you which rules to apply and when. And unfortunately, time is too short. This is a whole nother hour topic just to talk about 318 and 267 and all of that stuff in the context of figuring out filing requirements and related parties for Form 5472. So this is going to be homework for yourself when you're doing the 5472 project. Just a simple example of how this works, because it's intuitive and your intuition is correct, cross-reference to the code. You have your ultimate 25% indirect foreign shareholder at the top, and that person's spouse is a related party, and I've given you the cite to section 267, which the regs tell you to use, and that person is a related party. So if there were to be on the general ledger of subsidiary 2 a transaction between subsidiary 2 and the spouse, that would be a reportable transaction, foreshadowing what comes next. Because I like to share the pain, here is a table of all of the related party rules and attribution and construction ownership rules and cross-referencing where you find the code and the regs and what they're for. So this is just a little reference point that you can use as you're going through this stuff to make sure that you're being complete. And the final one is related to the reporting corporation, right? So we have the foreign shareholder and people related to that. Now we have the reporting corporation itself and people who are related to the reporting corporation. And that gives us the full universe of potential related parties. And who is this? So again, we invoke, courtesy of the regs, what does it mean to be a related party to the reporting corporation? So 267, 707B, 482, 318. A lot of homework, right? This is why I'm saying if you started with trying to identify all of the parties, naming the holding structure, and then talking to your client and saying, well, what's your name? And then you go through the Section 318 list of related human beings, and then you go through, hey, do you have any other shareholdings or trusts? Or you could quickly burn up all of your time trying to identify all of the people on the planet who are actual potential related parties. You don't need that. You only need related parties with whom a transaction occurred, and that's why I'm saying start with the transactions in the general journal and work backwards from there. So we've hit it, and part 3, frankly, is you're in the weeds for a while, and that's my experience when I do Form 5472 type of projects. But it's necessary, and you'll learn to know and love the Section 318 constructive ownership rules at the end of it for what that's worth. Now, let's go look at the type of transactions. What kind of transactions trigger the Form 5472 filing requirement? And again, just to beat the dead horse, we need a related party, we need a reportable a reporting corporation, and we need a reportable transaction between those two parties. So now we're looking at transactions. And there are 3 types of transactions that you will be looking at. And the type of transactions that you look at are going to depend in part on the type of reporting corporation that you have. So for everybody, namely domestic corporations, foreign corporations, and domestic disregarded entities, we will have transactions in U.S. or foreign currency, and we will have things that are not in U.S. or foreign currency but are for free or at a discount, or they're barter or they're cryptocurrency or stuff like that. And then, and those two are transactions you'll see when we come to it that hit the income statement. So this goes directly to the ultimate purpose of Form 5472, which is to identify earnings stripping where income is being stripped out of the United States and the U.S. tax base and being moved overseas and getting parked in some palm-fronted island enjoying zero tax treatment. That's what you're seeing, and that's going to be in parts 4 and part 6. For disregarded entities only, which is part 5 of the form, there's an additional class of transactions that are reportable transactions, and these are things that hit the owner's equity part of the balance sheet, capital contributions, distributions, things like that. And this is consistent with the plan where the government is not using this as a transfer pricing tool to smoke out bad stuff. They're using the Form 5472 for the disregarded entities as a method for identifying people who are using domestic U.S. entities, domestic in the U.S. entities in the domestic sense, for skanky purposes, namely hiding assets or tax evasion in the other country and things like that. So let's look first at part 4, which is transactions in U.S. or foreign currencies. So you see the list of stuff, and there's a whole bunch, and as usual, there's an other, which is line 21, for in, and this is tiny on my little screen, so I can't read it, but the next to the bottom one for the money out. So these are all transactions of the type that will hit the income statement and affect taxable income, with the exception of, while you're at it, will you please tell us the balances of loans receivable or loans payable to related parties? And so the government here, just in the interest of, I guess, simplicity in designing the form, is larding up what are a bunch of income statement items with a balance sheet item. But it just makes it simpler for them to compare principal balances of loans receivable or loans payable to related parties against the interest income or interest expense that's reported on Form 5472 Part 4. So that's why it's there. The obsessive compulsive anal retentive part of me says, no, don't mix up apples and oranges. But they did it. So here's the regs that explain what a reportable transaction is, and you can see in that highlighted part is anything else that is taken into account for the determination and computation of taxable income. So that gives you the clue of what they're trying to go for in part 4 here. And that highlighted one is the catch-all, so just because it doesn't specifically go onto one of the enumerated lines, there's that catch-all, and you're going to put it on there. And as noted, the loan balances. They want to see the loan balances to and from reporting corporation on one side and related party on the other side. The other type of transaction that works for everybody, namely domestic corporations as reporting corporations, foreign corporations as reporting corporations, and domestic disregarded entities, is barter-free cryptocurrency, blah, 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 blah. So this one's a bit messier and murkier, and I kind of wonder whether the reporting obligations are, let's just say, honored in the breach, to put it politely, because A, they might not be immediately visible, and B, it might not occur to you that you're going to have something that would be reported here. And C, why would you want to report it here anyway? Anyway, so here the non-monetary just means not in U.S. or foreign currency, and less than full consideration means discount, right? So I give you a little thought exercise here. Let's say you have a domestic corporation, 100% foreign shareholder. It buys a house in California, and it's a vacation home for the shareholder. So it's not being rented, not engaged in business. The corporation allows the shareholder to live there for free. Query, is this a transaction for which less than full consideration was paid or received? Well, kind of, yeah, right? You have a corporate asset that was used for free for personal purposes, not business purposes, by the U.S. shareholder. By the foreign shareholder. It's kind of like you have a general contractor that and the corporation just happens to own a yacht, and the owner of the general contracting firm just happens to use the yacht, go sailing on the weekend. I kind of wonder whether that's, something that should be listed here. Again, I think this is honored in the breach, shall we say, namely not reported. But you got that. More to the point, in my experience, more and more people and companies are starting to do business and making payments and receiving payments in cryptocurrency. And this would be the place that you put it there, because cryptocurrency is not currency. It's not U.S. currency and foreign currency. It's personal property. And therefore, if you want to think of it this way, it's kind of like a barter transaction. You give me 1 Bitcoin, I'll give you this car. That's a barter transaction, property for property. So this is where it would go. So for anyone preparing a return for any entity that's starting to do business in cryptocurrency, and we've seen companies that do 100% of their business in cryptocurrency, no cash money at all. So this is where it'll go. And then the final one, part 5. This is for domestic disregarded entities, and this is where doom looms and treachery lurks for foreign people who own domestic disregarded entities. So, and this happens, I don't know how often. So you have a non-resident of the United States who says, I got this business idea. I think I'm going to spin it up. While I'm still thinking about it, I'm going to form a Delaware LLC for a few $100. So they do. They pay whatever it is to the company that forms the LLC for them, and it just sits there. Now the question is, we know that we have a reporting corporation because we have a disregarded entity that has 100% non-resident foreign ownership. So it's a reporting corporation. And we know that we have a related party, namely the 100% owner, right? So that's 25% plus foreign shareholder. Well, 100% is better than 25%. Now the question is, do we have reportable transaction? Well, think of the cost of formation of the LLC and the annual fees paid to the Delaware Secretary of State, and the resident agent fee. What are these? Do they hit the income statement of the disregarded entity? Well, no, because it's disregarded, and all of the transactions are attributed to the individual for tax purposes. But for our purposes here, you pretend that the disregarded entity is a corporation and say, okay, well, we paid money for the resident agent fee every year. That's a deductible expense. So we've got something on part 4, right, technically. But what about the formation costs, and say that's kind of like that's a capital contribution to an entity, and then the entity used the money to form itself. And so that's not really a deductible expense, is it? I don't know. Could be, you amortize it off. But as you can see here in the regs, any amounts paid for formation, dissolution, acquisition, and disposition of the entity, and money in and out for any reason. So let's say you form it, and then they open a bank account. You just drop $10,000 into the bank account, and it sits there. Is that a reportable transaction? Yes, it is. So this is why I'm saying in 100% of the cases, where you have a 100% foreign-owned domestic disregarded entity, you should expect to have a Form 5472 filing requirement. So here's the regs under Section 482, which are invoked, and you can see how broadly they're defined. And Section 482 is the government's trump card. We can do anything we want and recharacterize things any way we want. So it gives the government an extremely broad license. And so you should treat all of the transactions accordingly and assume they're reportable until proven otherwise. Now, one of the questions, in fact, I got a call last week from an accountant about this, is someone who has done one of these things, formed a domestic LLC, sat on it for a few years, just paying the fees to keep it in good standing, and now they want to finally do business, and they're waking up and saying, oh, poop-a-doodle, I've got this Form 5472 filing requirement because I had $400 a year of transactions that I was making, and that triggered a Form 5472 filing requirement, and now I've got 3 years of Form 5472s that are late at $25,000 a year, 75,000 of penalties to use this little thing that I just had idling at the curb ready for my brilliant business idea so I could kick it up and go. What do you do? And my recommendation is you tell the resident agent that you're not going to be renewing it, you stop paying the annual fees to the Delaware Secretary of State, and you just let that little boat drift into the middle of the Atlantic, get beaten up by the sun and the waves, and eventually sink underneath the waves. Spin up a new LLC and start fresh. Just saying. All right, here we are with special rules, exceptions, limited information requirements, etc. The important idea here that I want to stress is, remember that Venn diagram that I gave you right at the beginning, where the intersection of the Venn diagram, reporting corporation, related party, and reportable transactions, creates Form 5472 filing requirement. That should just be your pessimistic outlook on life. And then after you get there and you say, I've got a problem here, then you start to look for exceptions, special rules that say, well, you got to file a form, but you don't have to fill in all of the form, stuff like that. So this is only after you've said, yeah, I've gone from analyzing whether I have a filing requirement to, yeah, I really do have a filing requirement. Let's get to work. The first one is kind of cool. And this is if you have two of the three circles, namely a reporting corporation and a related party, but you do not have any reportable transactions between the two of them, you do not have a Form 5472 filing requirement. So let me give you two examples. You have a non-resident person owns 100% of the shares of a domestic corporation, drops $10,000 into the corporation's bank account as a capital contribution. Is that a reportable transaction for the domestic corporation? Answer is no. Why? Because Part 4, it does not hit the income statement. It's not that $10,000 is not used in computing the taxable income of the corporation, nor is it a loan. It's a capital contribution. You look at Part 5. Part 5 says this only applies to disregarded entities, so you skip that. Part 6, it says, look at all the types of transactions in Part 4, and if you did any of those, except you did it with cryptocurrency or barter or at a discount or stuff like that, put it there. Well, the $10,000 cash capital contribution to the domestic corporation isn't on Part 4, therefore it's not going to be in Part 6 either. Therefore, a domestic corporation receiving a capital contribution of $10,000 does not have a related party transaction between the 25% foreign shareholder, who's a related party, and the domestic corporation, which is a reporting corporation. No Form 5472 filing requirement there. And if the domestic corporation then uses that $10,000 on expenses payable to unrelated vendors, for instance, whether services or whatever, then those expenses are not transactions with a related party, and there's no problem. So it's entirely possible when you just have a foreign shareholder just making capital injections into the company that there will never be a Form 5472 filing requirement. And logical if you think about it, because the government is concerned that something skanky is happening and net profits are being stripped out of the corporation and sent overseas behind the IRS's back, and that's not happening here, and therefore, why bother with the paperwork? But compare that to the disregarded entity situation. So we have a 100% owned domestic disregarded entity with a foreign member. The foreign member drops $10,000 into the disregarded entity's checking account as a capital contribution. And then that money is spent on whatever, third-party vendors. Do we have a Form 5472 filing requirement because of that transaction? Answer is yes, because remember, for Part 5, capital contributions are reportable transactions, and so it'll have to be reported in Part 5, and therefore there's going to be a Form 5472 filing requirement. Okay, the next sort of weird rule, and something to be really careful about. You have to file one Form 5472 for each related party with whom there is a reportable transaction. What does that mean? You go through the general ledger, you find transactions with 3 or 4 or 5 related parties, you better be filing a Form 5472 for 3 or 4 or 5 of those 5472s, one for each related party. If you don't, if you file one less, you've got a $25,000 penalty for the one that you should have filed, but you didn't, even though you were extremely diligent with the others. So this one is a gotcha, and again, this is why I take the general ledger first approach to these projects. Interesting exception for domestic related parties. So it's not just a matter of stripping money out of the reporting corporation and sending it overseas to foreign related parties. You can strip money out of a reporting corporation and send it to a domestic related party. And in that case, you still have to file Form 5472 and say, hey, stuff happened here, but you don't have to list the transactions themselves in Part 4. So the form must exist, but the detail is not required. And the theory there is sufficient for the government's purposes for you to flag the fact that money went over to this domestic related party, and if the government is concerned that something skanky went on, they're going to go look at the domestic tax return for that related party and figure it out. So this is just sort of a flag and a pointer for the government. I'm sure someday they will say, please make my life easier. Please list everything here on Part 4. So, it'll come. Disregarded entities, emphasizing this one more time, always file Form 5472. And what I said at the beginning, that we ourselves put our foot in this pile of dog poo, this is where we did it. And it was a foreign person had a grantor trust, owned an LLC, owned a house that he used when he was on vacation here in Los Angeles. Answer, 5472 filing requirement, if only for the filing costs for the LLC, but also because he would dump money into the LLC and use it to pay property tax and stuff like that. It took us 2 years after filing the request for abatement of penalties for us to finally get the letter back from them, but they said yes. Anecdotally, my buddies who do this stuff too are saying that the government is getting more and more hard-nosed at just throwing automatic 25,000 penalties at you for failure to file these forms. I'm also seeing this with foreign trusts, by the way. and they make you shovel snow uphill in hell in the summertime with a fork to get away from the penalties. So you really don't want to get into the mess of pleading reasonable cause and hoping that this mess goes away. All right. So I want to wrap up here. I'm going to cover the rest of the Form 5472 and the meaning of these other sections, but I just want to stop here because having gone through these 3 steps, we've now, I hope, given you a clue about whether there is a filing requirement or not. First, we looked at, is this thing the right kind of thing? Does it have 4 legs and bark? Yes, it's a dog. And they're different kind of dogs, namely domestic corporations, foreign corporations, and domestic disregarded entities with foreign owners. But we have one of these things. It's a reporting corporation. The second thing we did was we identified related parties. And just blurting out the number section 318 tells you that the possible universe of related parties could be very large indeed, and so that's kind of a messy thing. But you went through the effort and you finally identified them. And then the third part of it, to ensure that we have a filing requirement, because just those 2 alone don't make a filing requirement for Form 5472. The third one is the trigger of the reportable transaction. We figured out what a reportable transaction is, and we basically, at a very high level, say stuff that hits the income statement for corporations and every transaction for domestic disregarded entities are reportable transactions. So now we know we're in Form 5472 land, and you're going to start at the top and work to the bottom, filling it out. And let's go on to the final pieces of Form 5472 so you can see what they look like. I'm not going to spend very much time on them at all because it's not related to the question of whether to file or not. And each of these sections could be their own hour or plus in their own right. So the first thing is the standard litany of questions that everybody has to answer. So it seems like every form has one of these, Here's a bunch of things, check the boxes, attach a statement, blah, blah, blah. And Form 5472 has one of those forms, and this is the additional information form. So you're going to answer it. And I got nothing much to say about it except once you've answered it, you're done. It doesn't require as much brain damage as the rest of the form. The second part, and this is brand new for the latest iteration of Form 5472. So the latest iteration is the December 2021 version. This section is new compared to the one we used last year for cost-sharing arrangements. Cost-sharing arrangements are situations where 2 taxpayers, let's just call them 2 corporations in a corporate structure, but they're related to each other, both chip in for the costs of, let's say, developing a product. So there's a lab full of engineers and scientists busy working on some technology in some kind of corporate structure. We have a domestic corporation and a foreign corporation. Both of those say, we'll chip in 50% of the overhead for keeping these engineers and scientists going so they develop the product. And at the end of the job, we'll each have a 50% ownership in this technology. So that's a cost-sharing arrangement. Where the government is concerned is saying, domestic corporation and foreign corporation say, hey, we have this lab full of people sitting in Bermuda developing software, which wouldn't happen, and we're each going to chip in 50% of the cost of developing the software. And when we're all done, the foreign corporation is going to own 100% of the software. So what we've basically done is the domestic corporation has created a tax-deductible expense and has not, at the end of the day, put an asset on its balance sheet that will generate the income. So basically, stripped money out of the United States, gave it to a foreign entity for the future income generated by the technology that's developed. So this is what they're trying to smoke out. And again, I'm not going to cover it here because, frankly, in the world that I live in, this is, I just don't do these kind of projects. And the final thing here is our friend Mr. Base Erosion Tax. And this is part 9. It was part 8 last year, before the cost-sharing arrangement part was stuck in there. The important thing for you to know is this only starts to apply, and you only fill in this gap when you have a, quotes, applicable taxpayer. And that's somebody, or an entity, that has gross revenues of 500 million or more. And I commend the instructions to you. This is going to eliminate 99% of those of us in the audience from even caring about this. We're just going to leave it blank and carry on with our lives happily. So that's the back end of the form. That's the relatively easy stuff, I would say. A little moment on penalties. 25,000. It used to be 10. Now the penalty for 5472 failures is 25,000. I wouldn't be surprised if they crank up the 5471 penalties to 25 grand in a year or two. I think 25 is the new 10 because, we will continue to punish you severely until your morale improves. So, and the one thing I want to make sure of is that you remember this 15472 for each situation where you have a reportable transaction between the reporting corporation and a related party. So there could be multiple. Reasonable cause relief is possible. And again, good luck. So that's the thing to think about. Filing deadlines. Quirky filing deadline for this in the context of a domestic disregarded entity, because you don't want to be late, right? Foreign-owned domestic disregarded entity. What's its filing deadline? Well, if you look at the instructions, you have to bolt this 5472 to a dummy Form 1120. So the filing deadline for your 5472 is keyed to the fiscal year of this dummy corporation that you created a dummy Form 1120 for. Well, what's the fiscal year for a hypothetical corporation, huh? Well, you look at the owner, the 100% members, tax year for U.S. tax purposes, and you use that. And then the filing deadline is the 15th day of the 4th month after the close of the dummy corporation's fiscal year. So example, foreign human being owns an LLC. What's the end of the tax year? December 31st. Filing deadline for 5472 or an extension on 7004 is April 15. Finally, where to find the rules. And if you're doing one of these, unfortunately, I think you're going to go to the original source and read the Bible and read what the IRS wants, and you spend more time in there than you care to. So here is my list of stuff, code and regs, and we conclude with, again, my restatement of the recommendation. First, you start off figuring out if you have a reporting corporation, because that's the easy knockout. If you decide you don't have a reporting corporation, for instance, because you can't identify a 25% foreign shareholder, you're done. The next thing is, the next easiest knockout punch is looking at the reportable transactions and just identifying likely suspects. Usually it's going to be pretty easy when you look at transactions, say, well, this one looks funny because it's not like a payment to T-Mobile or to the utility company or something like that, where it's obviously a third party. And you're going to then take those likely suspect types of transactions, and then you're going to figure out if the counterparty is a related party or not. That's the method I use. Obligatory disclaimer. courtesy of my favorite guy on YouTube. So as always, don't try this at home. I'm what you call a professional, meaning go do your own research or hire somebody who knows what they're doing. Anyway, thanks for listening. Our next one will be on June 24. We're taking a 2-month hiatus, one for the filing deadline in April, and then the second one in May for vacation. And June 24, 2022 is the next session, which is Form 5471, the new handy-dandy schedules Q and R. Lucky times. Talk to you later. Bye.